Welcome to Talk Tickers. We're your guide through the maze of earnings calls.
That's right.
Today, we're jumping into the Q2 2025 call from a massive global beverage player.
Yeah, this one dropped intraday, just before the NYSE open. Gave us a pretty full picture of, where they stand and where they think they're headed.
Our mission, as always, is to really cut through that corporate speak and pull out the insights that matter for you.
And this call definitely made waves right away. The market reaction was quite telling.
How so?
Well, the stock took a noticeable hit almost immediately, saw really high trading volume, and crucially, a big spike in put options.
Put options. So basically, bets the stock price is going down.
Exactly. A clear sign of concern from at least some part of the market, even though management sounded, pretty confident overall.
Okay, so let's get into those numbers that caused the stir. The GAAP EPS, that came in at 0.03 cents, right? But the consensus was looking for 0.04 cents.
Correct. A miss there. And revenue was similar, $3.59 billion reported versus the $3.84 billion expected. So, yeah, on the surface, clear misses.
But you mentioned digging deeper. What's under the hood?
Right, because those headline figures don't tell the whole story. If you look at their normalized EPS, that's the figure that strips out unusual items.
Gives a cleaner view of core operations.
Precisely. That actually jumped 15.7% year over year to 18 Brazilian reais cents. And normalized EBITDA, another key metric, was also up strongly, 7.6% year over year to $6.15 billion.
And that came with margin expansion too.
Yeah, a solid 110 basis points. That's 1.1 percentage points better margin. So profitability looked pretty robust.
Okay, so it's a mixed bag then. Headline misses, but underlying profit growth. Gross margin stayed flat at 50%, but overall volumes, they did decline.
They did, down 4.5% overall. That's definitely a point of focus.
But then, kind of balancing that out, the board approved a pretty hefty interim dividend, our $2 billion, payable in October.
That's a big signal, isn't it?
Feels like one. What's your take? Confidence despite the volume dip.
Absolutely. It shouts balance sheet strength. They're putting cash back to shareholders and investing it strategically premium capacity, returnable bottles, not just chasing, say, bolt-on deals, suggests a focus on sustainable internal value creation.
Makes sense. Okay, let's shift from the numbers to the narrative. Management called Q2 a transition quarter. What does that really mean in this context? Setting up for growth or maybe just managing expectations a bit?
Probably a bit of both, but they lean heavily on the strategic side. Calling it a transition often signals they've made choices, maybe impacting short-term results, but aimed at long-term strength.
And they're still confident about the full year.
Very much so. They reiterated their guidance, high single-digit normalized EBITDA growth, margin expansion for the full year. And that's despite ongoing FX and commodity headwinds.
So they think the underlying business is solid.
Yeah, and they laid out these three core strategic pillars they're building on.
Okay, pillar one, leading and growing the category. This has to be where that volume decline, especially in Brazil, fits in. Down 9% there.
Right. And management's explanation was, pretty direct.
The weather.
The weather. They cited 65 more cold days year over year, said June was particularly bad, hitting key regions. They claim 70% of the industry's volume decline was weather-driven.
70%? That's a lot to pin on the weather. Is the market buying that explanation fully?
It's always a tough sell, isn't it? Investors will naturally wonder if there's more to it, but management's pushing hard on the idea that it's temporary, external, not a fundamental demand shift.
But even with that overall volume softness, you mentioned their mix strategy is working.
Yeah, this is key. Their premium and super premium stuff grew low teens, gained share in most of their top markets. And the balanced choice portfolio, that grew low 20s.
So they're successfully shifting toward higher value products. Better margins, even if total volume dips.
Exactly. That helps offset the volume pressure on the bottom line.
And it's not just premium beer, right? What about those emerging segments?
Oh, they're booming. Non-alcoholic beer volume surged 55% year over year. It's now 2.5% of their total volume, up from 1.4%.
Wow. And things like Stella Pure Gold via Z delivery more than doubled. Michelob Ultra up over 60%. They're definitely finding growth in these newer spaces.
But the core brands, the traditional stuff, did that get hurt?
It did see declines, yeah. It's more sensitive to the overall environment, and obviously things like bad weather hitting bars and restaurants impacts the core more. But they did say brand equity for the core actually improved, which helps limit the market share loss.
And they're actively trying to fix specific brands, like Skol.
Right. They talked about revitalizing Skol, seeing early positive signs, better distribution, point of sale stuff. They called it a V-curve recovery since Carnival. So it's not just about the new, it's about shoring up the foundation too.
Okay, interesting. Let's move to pillar 2 then. Digitizing and monetizing the ecosystem. This feels like where a lot of the future potential might lie.
I think so too.
Yeah.
And the numbers here are pretty staggering. Take their B2B platform, BEZ's marketplace.
The growth there was huge, right? Massive. GMV, gross merchandise volume, up 90% in the quarter. That's an annualized run rate of $7.4 billion.
90%.
And get this. Sales from third-party partners on B's, think Nestle, L'Oreal, PepsiCo, now actually exceed their own direct sales on the platform.
Really? So it's becoming a genuine marketplace, not just their own shop front.
Exactly. 80% of their Brazilian customers bought through B's in Q2. SKUs per customer are up. And the Net Promoter Score, customer loyalty, hit an all-time high near 70. That's incredible engagement for a B2B platform.
So strategically, it's about more than just selling more stuff online.
Oh, absolutely. It's about building this whole ecosystem around their retailers, getting deep data insights, and then you have Z Delivery, the direct-to-consumer side.
Right. GMV up 7% there, average order value up 11%.
Yeah, and it's a powerful engagement tool, especially with younger drinkers, Gen Z, millennials. They're almost 80% of the buyers.
And those buyers are more frequent consumers.
47% higher frequency of beer consumption than average. That's gold from a data perspective. You learn so much about who's buying what, when, why.
And they're making money from this directly, too. The monetization is working.
Definitely. Marketplace gross margin improved significantly, 400 basis points overall to 15%, and 600 basis points in Brazil specifically, reaching 17%. They're figuring out how to make the digital side profitable.
So it's not just about selling beer anymore. It's building this data-rich, maybe quite sticky digital business alongside it. Okay, pillar 3. Optimizing the business. Sounds like cost-cutting and efficiency.
Pretty much. Disciplined cost management is the name of the game here. They generated over $500 million in savings in Q2 alone.
Which offset inflation.
More than offset non-commodity cost inflation, yeah. And cash SG&A, selling, general, admin costs actually dipped. Leaner logistics, disciplined ad spend. It led to operational leverage of 2.2 times.
2.2 times operational leverage. Break that down for us.
It basically means they're super efficient right now. For every extra dollar of revenue they brought in, their operating profit grew by $2.20. It shows they can really control costs and squeeze more profit out of their sales, even when things are challenging.
And they're simplifying things, too. Fewer products.
Yep. Cut about 10% of their low churn SKUs, the slow movers. Makes breweries and distribution centers run smoother, more focus, less complexity.
And we should touch on Argentina quickly. Tough market, but they saw volume growth.
Oh, first time in 7 quarters, believe it or not, despite a 12% peso devaluation.
How are they managing that hyperinflation?
They stick to their hyperinflation cap methodology. Basically, a structured way to adjust pricing to keep up with soaring costs and the falling currency, protecting their margins. Seeing growth there is actually quite impressive.
Okay, so let's look at the bottom line financials again. Net income up 15% year over year to $2.8 billion.
And a much lower tax rate helped 18.4% versus almost 29% last year, mostly due to some tax exemptions on government grants and a favorable mix of where their earnings came from geographically. Big boost.
Cash flow from operations was solid at $3 billion, though down a bit year over year, reflecting those volume issues we talked about.
Right. And as we said, that $2 billion dividend underlines the balance sheet health. They're investing internally, hedging FX and commodities 12 months out, but in a non-speculative way, just protecting the business.
Okay, let's put this all in investor context. The market reacted negatively, focusing on volume and revenue misses.
Right.
While management is talking up margins, digital growth, dividends. There's a real disconnect there.
Absolutely. Investors are clearly worried about pricing power. Can they keep raising prices? How real is this digital monetization? Is the dividend truly safe long term?
And management's answers.
They say pricing will track inflation, helped by that premiumization shift. They point to the BES and Z numbers as proof the digital strategy is monetizing. And the dividend approval speaks for itself. It's that classic tension, short-term numbers versus the long-term story.
So looking ahead, what could get the stock going again? It had a great run, up about 35% year-to-date before this earnings call.
A few things. If Q3 weather in Brazil cooperates, volumes could bounce back. That October dividend payment lands in investor accounts. If Argentina's situation keeps stabilizing, that helps. And later this year, they plan to roll out financing tools on BEs for small retailers that could be another value unlock.
And there's that investor day coming up, October 30th. Sounds critical.
Oh, definitely. Huge spotlight. They need to show more progress on reviving Skol. They need to really detail how they'll use all that digital data for innovation in 2026. It's their chance to prove this is about balanced growth, not just pushing prices.
All right, let's pivot to our favorite speculative segment. Not financial advice, folks. Just kicking around some interesting, maybe slightly wild trade ideas based on the call. Remember, investing has risks. Do your own homework.
Absolutely. Disclaimer firmly in place.
So what's the first thought experiment?
Well, given that disconnect stock down on volume, but strong margins, digital growth, dividend, you could maybe think about a long margin, short volume hedged bet.
Okay, unpack that.
You'd go long this company, betting that the strong margin control and the digital scaling will win out over temporary, maybe weather-driven volume dips.
Right.
Then, to hedge the risk that the volume doesn't recover quickly, you could short a competitor. Maybe one that's more purely dependent on volume, doesn't have the same digital edge or premium brands. You're essentially betting on this company's specific strategic strengths relative to others.
Interesting. Betting on their execution, basically. What's the alternative, maybe more outrageous idea?
How about a digital ecosystem valuation unlock play?
Okay.
Look at BAE, 90% GMV growth. Look at Zed delivery, all that data, high engagement. The argument, maybe a bit out there but plausible, is that these digital assets are seriously undervalued within the traditional beverage company structure.
You mean they could be worth more on their own or spun out?
Potentially, yeah. So a speculative trade might be something like long-dated call options, targeting a strike price way above where the stock is now.
Betting that the market eventually wakes up and assigns a much higher value to that digital side.
Exactly. It's a bet on a future re-rating, heavily influenced by what they reveal at that October Investor Day about their digital plans for 2026 and beyond. It's betting the market sees the tech company hidden inside the beer company.
A very long-term speculative play on hidden value. Okay, let's wrap this up.
To summarize, yeah, Q2 was mixed. Volumes, especially in Brazil, were a concern. But the call really emphasized a disciplined strategy playing out. Strong margins, booming digital platforms, tight cost control. Those were the standout positives.
The road ahead definitely has challenges navigating tricky market conditions. But management sounds confident in their plan, suggesting they feel the company's actually stronger now than 6 months ago, even if the market didn't immediately agree.
And remember, again, this deep dive, purely informational, not investment advice.
Definitely not. But it leaves us with a question for you to think about.
In a world obsessed with tech platforms, could a company known for beer find its most valuable long-term growth engine, maybe its most overlooked asset, in its digital ecosystem?
Something to chew on. We'd love to hear what you think. Let us know what stood out to you from this earnings call.